I want to thank everybody for coming to our forecast meeting. And last year, a lot of people that are going to be on the webinar were actually, it's the last big event that we had before all the shutdowns was at Navasink, and we had a very good time and a nice night. So um, obviously it's different this year, but we're going to go through some of the same things, and you'll see. Um, really going to talk about where we've been in 2020, where we are now, where we may be going. And then in addition, for those of you that have been coming to that presentation for years, that's usually where I stop. But I am going to talk about some planning ideas for 2021. And as I'm meeting with you, I am considering a lot of these things as we're doing planning. So we'll just go from there. And if you guys have questions, please feel free to put them in the Q&A. And at the end, I'll open it up as well for questions. And I'll check on those every now and then. All right, so as you know, we start off with a quiz. So Emily Gould said, one exciting thing about being alive at this pivotal moment in history is that I'm constantly learning about strong opinions I didn't previously know I had. And I think that every day I kind of encounter that with just how different day-to-day life can be. But out of those four things, think to yourself, what do you think? Virtual school, bread recipes, remote work, or pandemic dating? And her answer is virtual school. So she said that, she has a 5-year-old son and it's very difficult to have them at home. And I'm very fortunate because my boys are, in eighth grade and 11th grade. And so they're pretty much on their own. And that makes it much easier for me and my husband. The next quiz is a popular 2020 meme was Da Vinci. It came about when an animated image of Sergeant Schultz winking at Colonel Klink's assistant Helga went viral. A do-it-yourself video about making keys using automobile VIN codes went viral. Influencers mispronounced the answer to the question, who painted the Mona Lisa, and it went viral. Or a sleeve emoji didn't work quite right, and it went viral. And it is the influencers, Chris and Patrick, who are twin brothers, who are taking a quiz, who painted the Mona Lisa. And when Da Vinci popped up, they both said Da Vinci. So very interesting, and seeing lots of interesting stuff out there lately. So that being said, we're just talk about where we've been. And we're really going to talk about two things, lots of things, but we're going to look at the economy, and then we're going to look at the stock market. And as you guys know, there's a pretty big divergence between the two, and I'll chat about that a little bit as well. So we look at themes and lessons from 2020. COVID, of course, was the biggest thing. And I remember I talked to a lot of you at this time when in March and April, we had these huge down days, like 10%, which you really hadn't seen. I mean, 2008, 2009 was bad, but really, really pretty severe volatility. But it lasted 33 days, and then it kind of came right back up. So it's the quickest decline to recovery on record for a bull to bear market, and then back up. So growth versus value. So growth stocks are really the ones that are more technology oriented, and they performed really well during the pandemic. And we'll look at that a little bit too, growth to value and cyclicals, and there's some interesting things there. Volatility, talked about that a minute ago, but the most volatile year since 2008, 2009. And then unemployment hit 14.7%, so like Great Depression type levels. And then number 5 is really the vaccine. So it takes a lot of time to develop a vaccine. Normally, this one was done very efficiently and quickly. And the markets did well. We're seeing some volatility yesterday and a little bit this morning on the downside. Now it's back up. But the market did respond favorably in Q4 to the vaccine. I'll talk about that. So when you think about the economy, it's kind of slow to get it going. So if you look at like a tractor trailer, especially going uphill, it takes a while for that to kick in, and you hate when you're behind them when you're driving. And the pandemic, of course, was like a huge hill to kind of get up, and still is. So what happened is that, we had the CARES Act stimulus. So there was PPP, and folks also got checks, and that kind of really helped. Also, rates are low, that I'll talk about a little bit more, and then quantitative easing. So the government is doing a lot to try to stimulate the economy, even though there's still a lot of speed bumps for us to get through. So when we look at the measure of the U.S. economy is really gross domestic product. And then what that is like taking every person, me with my business, you guys with your businesses and your work, and what we all create as a country, services, manufacturing, is included in GDP, gross domestic product. And normally for US, because we are a mature economy, it's generally between 2 and 3%. You'll see sometimes it's been better and sometimes it's been, worse. And we kind of had flattened out, and then it pretty much dropped off a cliff during COVID. So we were actually pretty negative, almost 9%. And we've definitely have retraced a bit. And it seems like we'll have to see how the vaccine goes, but we are gaining momentum. The one thing that's really tricky is that when you, like the statistics that you hear about the economy, about a lot of things, you really have to look a little bit under the hood, because they'll say that, our GDP was up 7% from Q3 to Q4, or we're up 33%. Well, we're still negative. So it's not, even though we're doing better and it's good to see those numbers, we still, it would be great to get back up to kind of where we were at some point in time. Also, employment gains stalled. So we had, more lockdowns at the end of last year, but, we had the unemployment go down, 14.7%. And we're back up to a little over 6%. And it's kind of stayed there. There's a jobs report this morning, and it's pretty much just like flat as it is. So we'll see, there's different types of unemployment too. So the rates remain elevated, not like they were in April, but the darker blue line here is actually the unemployment numbers that you hear that the government talks about. So 6.7% or so, that's this blue number. U6 unemployment is the lighter blue, and that includes people that maybe want to be full-time workers, but really only can find a part-time position, or it could be people that the unemployment ran out and they weren't able to find a job. So we'll have to see how this resolves itself. The thing that was interesting with the stimulus and unemployment is that I heard from many folks that they, because of the stimulus and the extra $600, that they were not going back to work. So they were just kind of not taking the money in, but they let their jobs kind of go. So that was kind of interesting that we haven't really seen that happen before. So the checks helped a lot, as we can see with spending, but it definitely hurt employment a bit and people getting back to work in some cases. So we look at consumer expenditures. Now, what's really important is that consumer spending is 70% of gross domestic product. So if we're not spending money, then that really hurts the U.S. overall as far as productivity and like taxes and employment and everything. So you'll see this blue line is actually the average of all expenditures. So we're still quite a bit, we're probably 7 to 8% lower than what people were spending before the pandemic. The green line is actually durable goods, which would be like home office furniture, automobiles, refrigerators, those types of things. The purple line are goods that, like, it would be masks and like PPP equipment, non-durable goods. The red line down here is your services. So eating out, getting your hair cut, those kind of things. So just, right along the lines with the pandemic, that's how the expenditures have gone, as we would expect to see. So hopefully we can get that blue line up a little bit higher, as we get opened up eventually. So in November, with the second wave of the pandemic, anxiety levels were rising. And actually, I have a poll for you guys on this too, if you're going to answer the questions. Is really this was done by Axios, and the stress that people had mostly are household debt was rising, worried about job security, harder to pay rent or mortgage. And actually, I saw some numbers this morning. About 18% of US mortgages are in arrears right now. And I haven't seen numbers on the commercial side, but that's probably worse than that. And then 47% are worried about just paying, day-to-day bills. So it looks like our group is more concerned with stock market fluctuations, which makes sense, because that can be nerve-wracking. And yesterday was a little bit of a nerve-wracking day, and I'll talk about that in a minute too. So we got stock market fluctuations 50%, And cash flow and job security were the two others, and then debt levels were 10%. Okay, so out of a poll between the folks that are on the call right now. Okay. So now we move on to the stock market. And of course, as I've discussed with many of you, we did have a really good market. I didn't think it was going to end up that way. I thought we'd be out of lockdown by June. But the market really did retrace nicely. So the S&P 500 is the 500 biggest companies out there. So the average price of those rose 12.1% in 2020. The Dow Jones is like Caterpillar, more your blue chip names, Coca-Cola, Merck, those types. That was up 3.9%. And the NASDAQ was the real winner. And you can see this year, we're doing Zoom and other things. So technology really did well. And the Russell 2000, top 2000 stocks up 10.4. So it was really large cap growth in the US that did really well. So you'll see Amazon, Apple, Microsoft, Google, Facebook. These are kind of the 5 leaders. If you guys remember last year, we had Netflix was also in there, but Netflix has kind of come down a little bit. So Microsoft's really kind of taken that place. So we don't have the FANG stocks, we have the FAM stocks now. The losers were energy, of course, and I think that'll continue with the new administration really moving more toward green energy. And then the value stocks. The value are kind of in line with Dow Jones, but that's when you're actually buying stocks at a discount and more of your blue chip companies that are around for a lot longer. So unlike the economy, which really is just, it's kind of struggling right now with unemployment and other things, the stock market, has really been like a race car. And we, up until a couple of days ago, we were continuing to kind of reach record highs, and we continue to do that. And now we pull back a little bit. That's completely expected. So we look at volatility. This year was the most volatile year, as I said, since 2008, 2009. And this purple line just shows a spike. And volatility almost always is accompanied by a down market. You usually don't have volatility to the upside unless you're looking at like some of the things lately, crazy volatility in like GameStop and AMC and some of those other things that are going on right now. But you'll see the S&P 500, when the volatility was highest, it was kind of going down, and then it flattened out. And then you'll see the S&P 500 here. The volatility now is less. It's a little bit up since yesterday, but still lower than it was early last year. So again, 109 days where the market was up or down by 1%. And the last time we saw something like that was 2009. Okay, so we've actually had a great, really good decade since then in the markets. And this is something that, so we talked about value stocks. And value, again, is like when you go to the store and buy something on discount, the value just didn't do as well last year. It's amazing the difference. This is the biggest disparity I've seen since I started my practice like 20 years ago between growth and value. Core would be your S&P 500. And then you can see large companies or brand names. They're really $5 billion and more in market capitalization. So, and then mid 1.5 to 5, and then small under $1.5 billion. So you'll see how those reacted. And then what's really interesting is when the vaccine came out, it actually flip-flopped. So you have value at 12.6% for large companies. So you saw some of those really do well. Like you saw airline stocks and others that would really benefit from having a vaccine and kind of getting back to an older normal. Those have really kind of rallied. And then we're still seeing the technology stocks kind of go back and forth right now. So we'll see how this year kind of ends up. I do think that business has kind of changed. And a lot of my friends and folks I know that actually work in Manhattan, they might be going in 1 day a week or not at all. And a lot of the businesses are not renewing leases and things. So it's going to be interesting and different. Some people are going in every day, but work has definitely changed a bit. So this is the price to earnings ratio, and it's a measure of value. So you take the stock price versus the earnings per share to get this number. So this is the S&P 500, so the top 500 companies in the United States. And you'll see the black line, these are recessions, And the black line actually shows trailing 1 year, and the lighter blue turquoise-ish line shows like what it is right now. So we have the PEs have pulled in a little bit. But this is where you'll see people that like this ratio a lot, like Warren Buffett and value investors, want to buy stocks when their PE is 12, maybe 16 at the highest. So you can see the overall S&P 500 is really pretty high. It's tricky because if you buy and sell based on the PE goes, let's say from 12 to 20, and you get out of it, you do miss a lot of like the ride. Like you wouldn't be an Amazon or Apple for all that period of time. So it's it's good to look at these things and see what's going on. But when people say it's overvalued, this is one of the metrics that they're talking about this with the stock market. So why did the market do so well? So the central banks are printing money and putting it out there. As a matter of fact, the Fed did buy exchange traded funds in the U.S. markets, which is unprecedented. Government stimulus with a PPP and the individual checks for folks. The big five that we looked at before: Google, Facebook, Apple, Amazon, and Microsoft. Those have just done really well and just grown significantly with everything going on. The stock market does look ahead. It's a leading indicator. And then low interest rates. So the low interest rates are really, it's a catch-22, because if you want to keep up with inflation right now, the 10-year yield as of this morning was at 1.1%. So if you loan $10,000 to the government, you're going to get 1.1% a year in interest. And unless you are super independently wealthy, and it doesn't matter if you keep up with inflation or not, that's a really difficult thing to invest in. So it's also forcing a lot of different folks and even companies to put more money into the stock market. And this is a low interest rate. So I talked about this, but this just shows the 10-year treasury. So, it's been low for a long time. Market forces are driving it higher because the Fed funds rate, so the overnight lending rate between banks, is at 25 basis points, so 0.25%. But this is kind of trended a little bit higher. With Janet Yellen coming in, she was around, so she's going to be the Treasury chair. She was the Fed chair way back in 2008, 2009. I mean, she was there with Bernanke, and she actually is into negative interest rates, which they actually have in Europe. Unfortunately, a lot of the rates haven't stimulated because people aren't going to borrow money if they don't feel comfortable. So, we're going into some interesting times here. And then end of bull market in bonds. So when you look back, early 1980s, rates were super high, late 70s, early 80s. So 15%. And then since that time, rates have really come down. So what happens is that bonds are kind of like a seesaw. And when you had rates that high, if you have, so you had 15%, new bond comes out, your bonds at 15%, new ones are 10, the asset you have, that bond, is actually worth more. So the market value is going up. So on the way down, you're getting two things. You're getting like a capital gain, and you're also getting a rate of return gain all the way down. So bonds, if you look at the 10-year rates of return, look pretty good. But now where do we go? So if you have bonds that are paying, 1%, and the new ones coming out are 2%, you're going to lag, and you can lose money in bonds pretty easily. So you want to be kind of short term and stuff like that. But it's interesting what's going on with the bonds. And unfortunately, as you get to retirement, you want to be more in fixed income, but this type of thing is kind of hurting that a little bit. So inflation has also been edging a little bit higher. The Fed wants it to be around 2%. And you'll see energy, of course, really much less expensive. Filling up your car is much cheaper now. Food is more expensive, and I actually think it's gone up more than that personally. But I always think inflation's higher than what they say. So each one of us has their own kind of like personal inflation rate, right? Like you spend money different than, we all spend money differently, and everyone's going to be paying more for different things. But we'll see. Hopefully inflation will stay low. I do think that with some of the supply chain issues. Like I remember there's a store in the next town over from me, and she sells clothing. And she's like, I saw her, this woman, I saw her early in December. She's like, if you want to buy stuff for the holidays, you better get in because a lot of the clothing companies didn't produce stuff. The supply chains were broken and there's not a lot of inventory. So this was the first time that I went into a few stores to buy stuff for the holidays, and I couldn't find a whole lot of stuff that I liked. So, certain things, food, some of that supply chain's been broken. We could see, some of that inflation on those areas spike a little bit more. So with politics, it doesn't really matter historically who's president as to what the rates of return in the market are. The only thing that we are looking out for that can impact it is different things like taxes changing, corporate taxes, individual taxes, capital gains taxes. I'll talk about that in a little while. So it's not really going to matter who is in there, but some of the policies will definitely impact what's happening with the performance. So another little quiz for you. So which of these shows was watched most in 2020? Lock and Key, The Queen's Gambit, Space Force, or Tiger King? And it was Tiger King. Tiger King won. Queen's Gambit was pretty good. I didn't watch the other two, but I watched one episode of this, I think. So where we are. So working and learning from home, still very big, of course. Trying to work with all that. And hearing kids and animals is normal now if you're on a conference call or Zoom chat like this. So when we look at we're going to look at like the bullish side and kind of the bearish side. So this is Robert Shiller, Yale economist. I usually quote him every year. And he thinks, with interest rates low and people putting money into equities because they really can't get returns a lot of other places, 49.1%. He's fairly bullish. And this is an investor sentiment survey. AAII is a very big group, and this is used as an indicator. And then, but they went and asked CFOs, and basically at Deloitte, they did a big survey, and 80% feel like the S&P 500 is overvalued. So they're definitely going to look at those metrics like price to earnings. But, so we have two different stories. So the CFOs that are working at the companies think that they're a little overvalued. So, also, we looked at the numbers after the vaccine. So this is really, there's been a shift from growth to the value side, large to small caps, which we didn't see for a while. Small caps usually lead out of a recovery. Not sure if that'll happen this time or not. Defensive stocks to cyclical stocks, stay-at-home stocks to out and about. And then the leaders kind of went to the laggards. So the Apples and others haven't, if you look at the last couple months, haven't, had that huge run up. But the way stocks are is it's really almost like a wave, right? Like you have this huge upturn and then you have it pull back in, and that's kind of the way it goes. So, we'll have to see what this year brings with the vaccines and things like that. Oops. So when we look at what things need to happen, so there have been delivery challenges with the vaccine. A couple of vaccine plants overseas have actually been bombed. But people getting them, making sure you get both doses, the requirements for some of the refrigeration, everything is a little bit tough. Long-term unemployment. So we'll have to see if jobs come back. Small business destruction. It's anticipated that maybe 50% of small businesses won't come back. And small businesses are really the largest employer. They employ like 70 to 80% of our population. So, economic relief package, what's going to happen? I've seen everything from $1 trillion to $3 trillion. So we'll have to see how that goes. And then there were in December with that legislation, there were some economic safety nets as far as paying back loans and mortgages and things like that. So we'll have to see, which of these continue, and hopefully the vaccine gets distributed efficiently and things like that. So where we may be going. So I was at their work from home housing market boom. So you're seeing lots of people doing home improvements, adding on to their homes. I was speaking with a couple down in Florida earlier this week, and they want to sell one house and buy another, and they're not sure what they're going to do because it's like so red hot down there. So people are moving. People are moving from New York and Illinois and California to Texas and Florida mostly. Americans are saving more money than ever before. I think first of all, there's not as much to do. And secondly, people are nervous about what's going to happen. Sustained innovation and technology adaptation. I've been talking to a lot of people. It's amazing what people have done during this time to really innovate. And then demand for cleaner energy and cars. And then pursuit of social justice. So we saw the NASDAQ has 3,000 members, and the NASDAQ board is requiring each of those 3,000 companies to have two. They want more diversified boards. So you have to have two diverse candidates, diverse board members at your company and on your board. So we'll see those types of changes going forward. So this is the 2021 economic growth outlook. Now this is not actual GDP. This is a percentage change. So when you see this is what they're really looking at, the IMF is U.S. change year over year will be 3.1%. So it's not really that we're going to have 3% GDP. It's just to change year over year, and hopefully it'll be at least 3%, so you can kind of get back over the hump of being negative. You'll see China and India. China did not have as severe lockdowns as we did, and I mean Europe actually had more. But you'll see every year when we do this, they're usually growing. Their GDP is generally around 5 to 8% or so. So their percentage to kind of retread is going to be more. What's interesting too is that in December, it was the first month where China actually got more net investment dollars into their markets than the US did. So it looks like we may be having a shift in assets. For the last 10 years, the US has been the place to be. So we'll see, what changes this brings. It could be a fluke or not. We'll have to see. So Morgan Stanley said world economies rarely move in lockstep. What they think might happen with the vaccine rollout is that all the countries, as they open up, will kind of move back up in pace, which will be great. So we'll see if that sync does happen later on this year. So the 5 risks are vaccine effectiveness. So we're not really sure which vaccines are most effective and what the long-term effectiveness of those are. The pace of recovery, businesses getting back to work, hiring people, we're not sure. U.S.-China tensions. So China has been flying some planes around Taiwan. I don't know if they're playing like cat and mouse or what. And then also, even this morning, I saw something about our legislators and the technology with China kind of kiboshing some of it because of information problems. So we'll see how that continues. Consumer habits, will people go back out and spend money when things open up? Will people go back out and eat in a restaurant or travel? And then investor behavior. So we saw some crazy investor behavior this last week with like GameStop and AMC. I mean, I think AMC was up like 300% yesterday. So it looks like some kind of like manipulation and some pump and dump schemes. So we'll have to see kind of what happens with that. So you're seeing a little bit of volatility and a little bit of kind of weird things happen. So we're keeping a check on that. Most of the stuff, the big stuff that we invested in is in pretty good shape. So high debt levels, slow economic growth, and our debt level is 130% of GDP right now. So we're the highest debt level ever. And if my debt level was that high, I'd be very nervous. But I think it's going to continue to go higher with what we need to kind of get everything moving and to help the people that need help right now that are unemployed and things. So Jim Rogers was with Soros on the Quantum Fund. He's written several books, and he lives in Singapore now. And he is very concerned about the debt. You'll see him often on CNBC and other places. He has a different perspective, and I always listen to what he has to say. So he says eventually we're going to be like, oh, what about all this debt? You know, what are we going to do now? It's going to be very difficult to unravel a lot of that. So we'll have to see. So looking at some of the experts, Stanley Druckenmiller, a legendary investor, he doesn't know where the market's going to go, 10% one way or the other, but he does think that we're going to have some rocky roads over the next 3 to 5 years. So we'll have to see if that happens. The Economist, basically, you know, COVID has changed a lot of industries, and you know, we may see some shift in different companies that we didn't think we thought were strong may not be so strong and may go out. Or, you know, there's a lot of companies that are much more nimble than a bigger company. You know, you think about like Kodak back in the day, or even like Lucent, like they just got beat, you know, eventually. So we'll have to see what happens with that. The way we work is changing, and of course, disrupted effects on air travel, commercial real estate. And it is going to have a big impact. I don't think we're going to realize that impact or really know what it is until probably the second quarter of this year. It takes a while for us to really understand exactly what's going on. We see numbers and things, but what is really going to be the impact? And then climate, of course, we're moving ahead with the climate change, or the solar and wind and more renewable energies. So that's going to be a big change as well. So that'll bring up new industries, and maybe old industries might fall a little bit by the wayside. And then it's also important to obviously look at risks in portfolios. So, you know, right now we're still pretty much at a market high. So I have been rebalancing portfolios, and I think it's a good time to, you know, kind of look at what you have, and, you know, if you are close to retirement, potentially scaling back a little bit. Okay, so that's most of the market information. So just take a little bit of time and just go through just different planning ideas, because there have been some changes with legislation. And again, as I'm meeting with you guys, I am considering all these. Some of these wouldn't really be beneficial either way, but I'm looking at all these things, and we have some new tools that we can use to help and look at these things with you. So we're going to go through these 6 different areas. So portfolio assets location and asset allocation, tax planning a little bit, retirement planning update. Estate planning is coming back because of some changes in legislation. General planning, so we want to make sure that we're planning for expenses that are coming up, and then distribution planning and Roth IRAs. So one thing is really looking at taxable versus non-taxable investments. And so, you know, you have taxable, which is your regular investment accounts, and then also any IRAs, and then you have the Roths, which are never really taxable going forward. So, you know, 5 to 10 years ago, for certain people, I never would have recommended a Roth because I don't think it made sense tax-wise. But I do think that with all the debt levels we have on a national level and a state level, that taxes may be higher when you retire. It's hard to say, but I don't, you know, the reason you do a 401k is usually because you're going to pay less tax than you are now, right? So you kind of defer that tax until later. We'll have to see if that's the case, but definitely looking at portfolios differently that way. Making sure your risk level is aligned with the allocation. So we do have a tool that some of you have used called Riskalyze. So if you want to do and I will be using it in some reviews as we go forward. So if we want to see if your risk level is aligned with the allocation that you have, we have that tool. That's important because if things do get rocky, we want to make sure we're staying on our path and not deviating, because deviating usually causes issues and underperformance. And then asset class opportunities. So, you know, we do have a couple of different things that we're looking at that we discuss with you, you know, individually, but looking at, you know, what are things happening? Is it time to look at international or not? And then some like commodities, and then, you know, other things like healthcare, we added to some portfolios as well. So also the need for tax planning. So we want to, you know, there's been some changes with capital gains. Well, sorry, tax brackets have changed a little bit. So we want to make sure that we're looking at that. Taking IRA distributions when you're working, you just want to make sure that you're not going over that. You know, if you can help moving into a next bracket, it will save you money. And it can also save money on the for Medicare and different things like that too. Capital gains at the end of the year for the taxable accounts that are regular investment accounts, we do call and say, hey, do you want to kind of reset it? We want to make sure we're offsetting short-term and long-term capital gains. So right now, if you hold a stock or a fund for over a year, your maximum capital gain tax would be 20%. Under a year, it's taxed at regular income tax rates. And going forward, there's been talk about long-term capital gains may also be taxed at regular income tax rates. So that could be a change. We'll have to see what happens. So retirement planning update. So again, we want to make sure that we're optimizing withdrawals. This is really more for folks that are in retirement or close. So we do take a look at this and make different recommendations as far as when you may want to take certain distributions from different IRAs. We also have had some clients take these qualified charitable deductions. So they'll actually take money directly from an IRA and send it to a charity. And that can help with the tax base as well. So it's just something that it's just another strategy that we can use. Roth conversions, if it makes sense, we can convert Roth. Sometimes it can be a pretty big tax bill, so we want to consider that. But that's one thing. And then mini conversions over several years. For some, we do backdoor Roth conversions, and if they make sense for you and you can do them, we've most likely talked to you about these. And then also the Secure Act. Really, so the Secure Act is tough on IRA distribution. So my mother-in-law unfortunately passed away a couple years ago before this new law. And so my husband is able to take IRA withdrawals every year until he passes away. The way they've done it now is you have to take those distributions over 10 years. So it's good to take a look at what your taxes might be. If you're closer to retirement, you may wait and take all that money out when you've retired, because then you won't be working and your tax bracket may be lower. Or if you're working, it may make sense just to take little pieces out over 10 years instead of taking big chunks where it would impact your taxes. So different planning on that area as well. And estate planning, again, there have been some changes recently with the IRA distributions. Also, they can shift some asset ownership to kids when you're ready for that, which can take advantage of lower tax brackets. Annual gifting, each person can give away $15,000. Gifts for medical expenses, tuition don't really fall under the overall gift. So that is kind of a good way to do it. Also, there is a way that you can transfer highly appreciated stock and other things to save some taxes. And then also distribution planning and things. It's also just important to make sure that there's beneficiaries and contingent beneficiaries and that you're pretty much set on all of the estate planning side. So having good wills, having the registration in your accounts proper. We will talk to you about all that as well. And then this is just, I don't think anyone on the call has company stock in their 401k plan, but there are specific rules with that. And you can really save a ton in taxes if you actually handle that the right way. A lot of people don't. It's a pretty technical issue. So I don't think that applies to anyone here, but we want to make sure that we're taking a look at anything new that you may want to add to portfolios, which we help out with, reallocations, and then any large withdrawals, you want to watch those as well. And then look at company benefits and then major life planning. So, are you changing jobs? Will you be moving? What kind of things are happening and helping to plan. And for those, we do planning for a lot of our clients, and some we don't, and some may not want it. But doing that retirement projection at least really can help make sure that you have all your ducks in a row in the long run. So we're happy to help out with that. Also is education planning and different things that we can do there. I did have somebody call a couple of weeks ago whose daughter is going to college in like a year or two, and that's a little bit late, but when kids are younger, we can do some pretty neat things with the 529 plans. And then just review your plan and making sure that you're on track for retirement. There's also, again, Roths can be an amazing tool, especially with taxes most likely going up going forward. So, we just want to make sure that we're doing them the right way. And in certain years, it may make sense to take out Roth money instead of traditional IRA. Normally, you want to keep Roth money till the end and use it then. But it can be tax advantageous to take it out kind of along the way. Okay, so And also there's some advantages to leaving those to children and other beneficiaries as well. Okay, so those are the 6 planning ideas. There's a couple things. So I talked about the Riskalyze allocation tool. We also have 2 other things that some of you have taken advantage of. One is, if you haven't taken Social Security yet, we can actually do an illustration for you on Social Security. So let me know if you're interested in that. And then also, we just added something where we can take a look. Now, I'm not a tax advisor. I know about taxes, but we do have a tool where we can take a look at your last year's tax return to see if there may be places where we can help to cut taxes going forward. But anything that we discuss will be approved by your personal tax advisor. So that's that. So I want to thank everybody for being a part of this today. I'm going to see if I can see if you guys have any questions and just kind of open it up here. So if anybody has questions and wants to go off of unmute themselves. Please do so. And if not, I want to thank everybody for your business and for your support. I really appreciate it. It's been definitely.
Margaret?
Yes.
Hi, you said you were going to talk a little bit about GameStop and what happened yesterday in the market.
Oh yeah, I think that, so basically, so what you're hearing in the media is that basically the hedge funds got squeezed by that. But what happened is that everyone just kind of jumped on. What's going on, I think, a little bit with the market is that there's a lot of people that are doing some day trading, and they hopped onto it and just, rocketed really up. So if you look at like penny stocks or others, they call it like a pump and dump. So they kind of run into it and then get out. So over the last year, it's been, if you're invested long in a growth stock, you've done really pretty well. And it gives people a false sense of confidence that everything's okay. So, I mean, people ran up into it, and then I'm sure it's gotten sold down, although it was moving up higher. But like AMC is down like 38% today, and that was up like 300% yesterday. So people are running into it and then cutting out of it. So it's pretty much a manipulation that's going on. It's just interesting. So
It's something that one would avoid.
Yeah. I would. I mean, unless you're a day trader or something. I was actually talking to somebody yesterday, who owned it, and I was like, you might want to just kind of cut out of it because you just don't know, and it can move really quickly. And there's a lot of these institutions that have a lot more money than any of us, and you can get really hurt kind of playing that game. And who knows if it'll really go or not. And then you'll have the fuel of the fire, because then on chat boards it'll say, oh, it's going from 200 to 1,000 or whatever, and then it can get very emotional, and then you kind of get the pushing forward, and then it just kind of creates this huge uptick, and then you can get slammed. I mean, it could also keep going, but that type of pattern usually at least pulls back in and then can go. And one example is a few years ago when a lot of the marijuana stocks came out, they really popped high, especially like Tilray popped really high, and then it came right crashing back down. You just have to be careful of those types of things. They can be really tricky.
I think I also heard today that the government might be looking into that kind of a situation where people are taking advantage of the market.
They might be. And you know what, Rachel? I was reading that. I read the same thing. The government usually, when they really look into it, they really don't know what really happened, so it's hard to say. I'd have to research a little bit more. But it's definitely a big manipulation.
Thank you.
Sure. Okay, so question. So the question was about Biden stopping the Keystone and the green initiatives and thoughts about that sector. I definitely think there's some opportunity there. We are looking at some things. It is a volatile sector as well. So it could be a good spot for a portion of your money, or potentially like individual stocks or something like that to go in. But I would be a little bit careful on that side. But yes, there definitely will be opportunity. I think the oil and gas sector is going to have a little bit of tricky times going forward, just because of legislation and.
Green New Deal.
Sorry? And so, I think those are things that we're looking at as well. And I know that TAN is one exchange traded fund that covers a lot of solar and renewable energies, and it did very well last year. So we'll have to see. I think it's going to be difficult to push the green initiatives as far as they want to, because when you really do the research and look like at California, they had them do, they wanted 20% of their energy to come from renewable sources, and the technology isn't as far along as you would think. So in California, I don't know if you guys have heard, they have rolling blackouts fairly often, like 3-hour rolling blackouts throughout the state. Because the utilities had to implement these changes. So I think it's the more renewable energy and using solar and wind is phenomenal. It's just not I don't think the technology is quite there yet. But with the legislation, it will be a good place to look at. And then there's a question on like the vaccine companies. And I think that, so if you look at Pfizer, it actually didn't have as much of a pop as I thought that it would from having the vaccine. But those are things that we're looking at. And for a lot of folks that in the portfolios that we manage, we did put in a healthcare fund that would have, Pfizer. It would also have Merck, who, has tried to make a vaccine, but theirs just didn't have very good success. So, one that some folks have is Moderna, and Moderna has done pretty well. But it's hard. It's very hard to say. We could, I'm looking at it on a case by case basis, and we do have some healthcare in there, but it can be a little bit tricky. So. Anybody else have questions?
Ask her about the Green New Deal. What her opinion is.
Green New Deal?
Yeah.
I think it's, my opinion, I think it's good to have renewable energy. I just don't think that we're ready. The infrastructure is not there to go completely green. When California is a really good example of that. And so we'll have to see what happens. Hopefully it'll create new industry, and hopefully the technology, maybe they'll, with the innovation that's happened, maybe, it will be able to support it. But right now it can't support the energy that we use. I have an electric car that I just got. And thank you, Ryan Kimmons, I think you're on the call. And basically, you're plugging it in, but the energy is coming from, gas and natural gas and oil and stuff like that. At this point in time, it's coming through the electric grid, and the new stuff cannot support that. So we'll have to see. It'll be a little while, but I think eventually we might end up with, nuclear, which can be scary, but it's the cleanest energy that does have the oomph behind it that could power, what we need here in America in our grid. Anybody else? Okay, everybody, thank you so much. I'll be in touch with all of you, and if there's anything you need, or if you want to set up an appointment, just let me know. On the bottom, I'm going to send an email. On the bottom of my email is a schedule. There's a scheduling link there if you want to set up time. Sorry. And so if there's anything you guys need, just let me know. Okay, I'm here to help out, and we can, certainly be using the new tools and things as we do planning going forward. Okay, so thanks so much. Have a great day, and I'll be in touch.
Thanks, Margaret.
Bye-bye. Thanks, guys.
you.
Bye now.
Mark.